Hi guys, Marcel from Advisor here, and today I'd like to talk about investment market volatility. So this is generally the ups and downswings that an investor can expect to feel or see in investment markets, so when you invest in the markets. Now this is something I cover in Module 3 of the Plan Your Finances project. So if you're ready to jump into how to avoid probably the number one investor mistake, stay tuned. All right, guys, so here's how to avoid one of the most common investor mistakes that I see people do all the time. Even some advisors fall victim to this trend, right? And I'm going to set the stage here a little bit by explaining that markets usually deviate from normal, right? If you have an investment that you're hoping does 6%, it's going to be 6% plus or minus a certain amount. So it might be 6% plus or minus 18. So one year you could be negative 12, the other plus 24, but you're still hoping that the average is around 6%, right? So there's deviation from what is expected. That's normal. Markets get excited and they go up, and then they get fearful and they go down. That's just a part of investing. Generally, over a long period of time, they tend to go up. And they tend to go up a lot. But in the short term, there tends to be ups and downs. So the number one mistake that most investors make is called timing the market, right? It's trying to avoid the pain of losses and to increase their overall returns over time. So you've all heard the term buy low, sell high. Right? So the idea would be that, for example, right now markets are heading down a little bit. So it's normal. People are fearful and they don't like seeing their investment amounts go down. They forget that this is a normal part of investing, but timing the market is basically saying, all right, well, I'm going to take my money out of the investment markets before they go down. I'm going to avoid the down. And then here, right before they bounce back up, I'm going to jump back in and put my money back to work in the markets and enjoy this ride on the way up. And I'm going to try to repeat this based on signals I'm getting, word on the street, information on TV, Reddit, wherever, right? Could be your advisor's advice. Who knows? But the problem most people don't understand is that making that call is pretty much like catching a falling knife, right? It's very, very difficult. There's millions of very well-educated, well-informed investors, and even they, economists, professionals, really never know exactly when the market is going to go down, and they don't know how long, and they certainly don't know when it's going to turn around and come back, right? There's a million guesses out there, but no one really knows. The only thing that I know is that I don't know, right? I know the general stuff, but I don't know when the market's going to turn down or when it's going to turn up. So I don't coach my clients to try this strategy. So it's very, very difficult. The second thing that most investors forget, or the other thing that makes buying low and selling high or timing the market very difficult is that you have to catch that knife twice. So it's not enough to say, okay, I got out at the right time, but then you have to get back in for it to be worthwhile. Because if you don't put it back in here and you miss all of that, well, by the time the markets are here, you've missed out on all of this, which is more than what you've lost there. So you see, even if you get one of the calls right, you have to get the other one right. So you have to catch the falling knife twice in order for it to even make any difference in your investment returns. So the best approach is to avoid market timing altogether and give yourself time in the market. Time in the market tends to beat timing the market over time. So if you have a longer time horizon of several years and you can go through a couple cycles, you're most likely to get the expected return that you were hoping. You're just going to have to tolerate the peaks and valleys around it. So avoid the number one mistake of trying to stop the pain of losses or trying to get the thrill of, getting better returns than expected, and plan for the expected, knowing that there's going to be deviation from that. All right. So this is how I teach my personal clients. This is part of module 3 in the Plan Your Finances course. And then some. There's more important lessons that I teach here about how to be a better investor. So if this is helpful to you, please share it, like it, comment below, or reach out if you have any questions or you'd be looking for any coaching. I'd be happy to help. All right. Till next time. Cheers.